Welcome back, everybody.
Money Mondays, sorry, we had a little bit too much turkey. We're still getting ourselves figured out for the day.
It's all good. But welcome back, folks, with your hosts, Ben Suttles, Ferris Musa, and a very special guest. What is your name?
Lillian Suttles.
Oh, Lillian, back to co-host the Money Mondays. What are we talking about today? Stuff.
That's what I tell everybody.
Characteristics
Of a profitable multifamily investment.
All right. So characteristics of a profitable multifamily investment. So we're going to get right into this. You're going to help us out along the way, aren't you? You're not going to help us out? No. I thought you wanted to be on the show.
Yeah, Ben doesn't know anything about profit, so we need some help on that one.
Funny guy here. All right, so we've got some questions that came in before the show. We're just going to get right into it, folks. So what factors impact the profitability of a multifamily investment?
The numbers.
Ooh, there's a lot in that question. I would say, obviously, where you're buying.
Where your cap rate. Cap rate is the first thing that tells you what can I make on this deal as is if I do nothing, right?
Yeah.
Maybe the very first step, right?
But I'd also say cap rate can be deceiving depending on what market you're in, right?
Well, more so depending on actually what your leverage looks like. Because you can have a good cap rate, and if you have worse debt, well, actually you're still underwater, right?
Yeah, true.
So I'd say those two things are probably the first and foremost. Those need to be aligned, right? So as interest rates go up, cap rates need to go up because that spread is something you got to figure out a way to close the gap, which probably leads to a good second factor, right? Which is what?
What the submarket is, right?
So, I was going to say rent growth, right? Things you can do to start to close that gap.
So let's recap, right? Cap rate. We've talked about this on past shows, right? Is if you did nothing and operated it the exact same way, how much would you make each year if you paid all cash, right? So typically people would say, well, if I buy a higher cap, then that's a good thing. But depending on your debt, that could be a misleading metric. The other thing to kind of take into consideration too is the submarket that you're buying into, right? Because some people, all they care about are cap rates, right? But if you're buying a 10 cap in podunk nowhere, guess what? You might have very good cash flow, or maybe not. It just depends on your expenses and the debt that you can get. But you're ultimately probably going to sell it as a 10 cap as well, right? We typically like to blend cash flow with high appreciating markets. That's why we invest in the Sun Belt. That's why we invest in primary markets, right? Because you're going to get a good mix of both of those, right? So you're looking at cap rate, you're looking at the debt that you can get on it, you're looking at the sub-market that you can buy in, right? And then like Ferris said, right, you've got rent growth. Now, any one of those is not better or worse than the other one. They're all important metrics that you have to take a look at.
Yeah, and as an operator, right, we're looking at all those, evaluating, and ultimately trying to figure out, okay, what can we do to drive that NOI to actually make a non-profitable deal profitable or make it more profitable, right? So if I can go in day one, upgrade all the units, push rents $200, great. Now I've pushed rents, I can generate new revenue, therefore making it profitable. If I can install carports, same thing, right? If I can just boost the occupancy, all these things are things that are basically about pushing the NOI to drive that profit up and hopefully to make it a profitable deal, right?
You're forcing appreciation, right? And the only way that you're going to get appreciation on commercial real estate deals is to make it more profitable or that your cap rate compresses, right? What's happened over the last 5 years up until about 6 months ago is that profits were going up, maybe not, crazy, but they're still going up, but cap rates were compressing like crazy. And so everybody was making money, right? So if you have those in your environment, then you're going to be all right. Right? So those are some of the factors that you're going to need to look into in terms of a profitable multifamily investment, right? So how has your investment strategy changed from the rise in interest rates? And we've talked about this a little bit, right? Obviously deal flow has considerably slowed down. And I think that that's probably going to be, a factor that we're probably going to see for the next 6 to 12 months. I think anybody that can hold on and not sell for 6 to 12 months and get a little bit better of a price after everything kind of settles down are probably just going to hold on to their deals, right? So the only people that are selling right now are people that are coming up on a loan term, have to wind down their fund, and they have to sell. Think BlackRock. Well, who doesn't want to buy a deal from those guys, right? If they're just giving it away, they don't care if they make money, or they're distressed, right? Their partnership's fractured, the deal is just imploding. There's something bad that's leading them to force of a sale, right? And so our investment strategy has been very much be a little bit more patient and be a little bit more conservative with that underwriting, especially when it comes to interest rates, especially when it comes to rent growth. The times that were 6 to, call it 8 months ago, when you're underwriting to, these big gigantic, rent pops when you're putting a bunch of money in and then, 3 to 5% in rent growth, you still might get that in certain markets, but it's probably better, at least for the next 12 months, unless you're putting a considerable amount of money into the deal, to probably be a little bit more conservative with that rent growth, right? So I think that's another investment strategy that we've seen. And then just being smart about how we structure the capital stack, right? Whether it be, agency debt, with a preferred piece or not, and really just structuring that properly so you can obviously get the best returns that you can and ultimately mitigate the risk for your investors as well, right? So I would say that's kind of how things have changed.
Yeah,
What do you think?
and then just really, I think right now the biggest thing is about structuring. What are you doing to effectively structure your reserves, structure your cap, right? Your interest rate exposure, all the other pieces. So, on deals we're doing now, folks, going lower leverage, right, which reduces our debt burden.
Yep.
Right, and we're spending the extra money to buy the caps, which again reduces our upside risk. And last but not least, I had a third one there, but
Reserves?
I forgot it.
Are we talking about
reserves,
reserves?
right? Yeah,
Yeah.
So boosting significant reserves and making sure that, hey, we can ride out the storm.
And you know what that all equals, folks, is mitigating risk, right? And you try to mitigate risk, especially in times of uncertainty. Right now, it's not necessarily that the economy's bad, right? But we don't know what the next 6 to 12 months are going to be, right? Especially in 2023. Are we going to have a recession? Are we already in a recession? If we are in a recession or we're going to be in one, how bad is it going to be? How long is it going to last, right? Our rent's going to go down. Our value is going to go down. We've already seen values go down 5 to 15% in certain markets and with certain assets over where the peak was, which was back in, Q1. Right, so you have to realize that that's some significant value drops, and it's better to kind of err on the side of caution right now. Get yourself educated, get some dry powder, do your networking, find your next partner, find your next deal, and then pull the trigger. Right, it doesn't hurt to be a little bit patient when things are uncertain. But we're still in the market, we're still making offers. They just have to make sense, right, based on these reserves and how we're structuring the deals. Right, all right. So what is the criteria a property must hit in order to consider it a viable investment? Occupancy, year built.
$100 million.
Oof, wow, we're already back up to 100?
100.
All right, so this is our buy box, right? We've talked about this on a lot of shows, and it's changed. It really has. Now we're trying to do newer stuff, better parts of these sub-markets that we're already in, the primary markets. Where do we live?
Somewhere.
We live somewhere?
Yeah.
Do we live in Houston?
Over the rainbow or under the rainbow?
Houston.
In Houston. All right. Caught you off guard. Do we live in Texas?
Yes.
Do we like Houston, Texas? All right, we do. All right, so we love investing in primary markets like Houston and Austin and DFW, and then ultimately Atlanta and parts of Florida, right? So that really hasn't changed much. But even within these markets, folks, they can be dramatically different, right? And I don't like to pick on anything about the east side or the south side of Houston, but historically not as good as the north or the west side. And so we're trying to kind of stick in that quadrant within Houston itself, and there's certain pockets within all these other primary markets that we like to be in as well. So we're getting a little bit more dialed in the submarket that we want to be in. The year built is very, very important for us, right? We'll do a 90s deal. We're doing a 90s deal right now, but we'd love to stick to 2000s and newer, and I think that trend is going to continue, right? Unless we just can steal it from somebody and get another value add deal that's built in the 80s. Occupancy, typically like to see that stabilized deal, right? Especially with us kind of going more agency, more long-term debt. We're back into that cycle. We're looking for 90s and for at least the last 90 days, right? Which is what the agencies are looking for, which is 90% occupancy for the last 3 months, right? They call it 90 for 90. And so that's kind of the occupancy, right? But we're ultimately value add guys. We love buying deals that we can put good money in, create a community, enhance the value, enhance the rents. Therefore, obviously, it's going to appreciate. That's still our bread and butter, and we're going to continue to look for those deals. But you can get those deals even if they were built in the 2000s, right?
Absolutely.
You know, we're going through ones called Heights on Katy right here in Houston. It was built in 2004.
Yeah,
we're still putting $2 million
it's
bucks into
about
that.
finding the opportunity, right? Every deal has a different story. It's not all cookie cutter. A lot of things are similar, right? But again, every deal has a story. It's about understanding that story and figure out what you can execute.
Yeah.
So that said, Money Mondays are just every Monday, 3:30 Central. If you have comments, questions, thoughts, please ask them. We will answer them here live.
Yep.
$1 per question.
$1. Yeah, no, and ultimately, if you guys have suggestions on shows, questions that aren't even related to the topic of the show, as long as it's not too crazy and harebrained, we will go ahead and answer those too. So drop those in the comments if you would. But let's keep moving along here. So how do you know if and when you're making the right investment? I think you're going to know when when you buy, really, right? You're buying at the right. Are you buying in the right submarket? Are you buying at the right cap rate, right?
And I'll say you don't usually know whenever you first close, right? It's really 6 months to a year after that you really know, hey, this deal is humming along just like we expected.
But there's ultimately ways to determine that, at least somewhat.
Yeah, you got to go and have a business
Yes.
plan, make sure it makes sense.
And you got underwriting that you're going through. Right.
Modeling makes sense, but I mean, still reality. Sometimes there's deals you close on and you're like, man, this thing is a home run. It's completely crushing our numbers. And so.
No, there is. But the way to mitigate that, folks, is getting familiar with the numbers, getting familiar with a spreadsheet model that works for you, right? And understanding, because your chances of success are tremendously increased if the numbers, and as long as it's being conservatively underwritten, are there, right? Your chances of not being successful if things are really, really tight, because we know from being operators that things are going to go wrong, right? And the more meat that you have on that bone, the more likely that you'll be successful, right? But there's been deals. I mean, I still remember Central Park. I'll just go out and name what it is. That was one of the most challenging closings that we've ever had. Remember that deal? Oh my gosh. I thought we were going to lose our earnest money. Freddie totally ghosted us. The whole entire thing.
We're trying to figure out who had $6 million liquid to loan us.
Oh yeah, we were going to go with a hard money lender out of California to buy the dang thing cash. We were so desperate, right? And we almost went that route.
I remember one of my friends, Greg, had exited his deal, and I'm like, he has the liquidity.
Yeah, no. So I mean, like we were looking at anything and everything. So we were like, okay, is this indicative of how the deal was going to go? And guess what, folks? We ended up making 140% in less than, I think, 2.5 years, maybe 2 years on that deal. So IRR was through the roof. It was like 50 or 60%. I mean, it was stupid. But so you can't really, like Ferris says, you can't really tell just right from the beginning, right? You got to get a little bit of time. But also don't think that, hey, if you're having challenges getting it across the finish line, that might not still be a successful deal. You just never know, right? But better chance of success by underwriting conservatively and having enough meat on that bone, because things will go off track sometimes, and you always want a little bit of wiggle room. All right, moving along. When evaluating an investment opportunity, what do you look for when it comes to the condition of the property? Anything you advise investors to look out for? All right, so would you like to live in a nice house or a crummy house?
Nice house.
A nice house, right? Well, we like to buy somewhat good-looking property.
Or properties we can make
yes,
look good.
Or that's actually a great point. Very good point, right? That we can make to look nice. And I think that any amount of money, right? And obviously it's got to make sense within your business model. You can make even some of these 60s and 70s deals look very nice, right?
And not everything you're going to be able to go target the young millennial, right?
No.
But you can create nice, clean, affordable housing.
Yeah, so, what are we looking for, right? I try to get away from challenging things that, from a maintenance standpoint are going to make it tough, right? Not to say that we wouldn't do a flat roof deal, but I try to avoid them. Not to say that we wouldn't do a deal with chiller and boilers. We've done them. But I try to avoid all that stuff when I can, right? Because from a maintenance perspective, it's a lot more challenging, right? So those are some of the things that are real big hot button issues. Obviously, stuff that's clearly having plumbing problems or clearly having foundational problems are going to be things that we're going to probably not do. Things that have a lot of down units, you got to be careful of, right? Because people kind of get in like, oh, that's meat on the bone, and we've done those deals, we've made those assumptions, right? But that meat on the bone is going to cost you a lot of money to actually bring back online, right? Because that deal that down unit that you thought you could probably get for 20 grand right now is probably going to cost you 40, right? So just be careful getting into situations where you have too much either deferred maintenance or too much CapEx that you just ultimately can't handle, right? You can see that right from the property tour, right? So those should be some of the things that you're looking out for. And again, not to say you can't make money on a chiller deal or a flat roof deal or a boiler deal, or maybe you have a property that's had all three, and I have. Still very, very successful deal. Almost 100% return in 18 months. So, but just be on the lookout for those types of things.
I agree.
All right, last but not least, tips for identifying strong value add multifamily investments. I think this is all kind of along the same vein, right? You know, you're looking for good submarkets, you're looking for what's in your buy box, you know.
There's the obvious, but I'd say one thing we've learned over the years is really knowing who the buyer is, seller.
That's actually true.
Right, that really
That's
is indicative of what you can do with the deal, you know, what condition the deal may truly be in, right? And ultimately understanding what the seller's plan was and what their exit is and why they're exiting, right? There's nothing wrong with sellers leaving meat on the bone, right? Again, you capitalize these deals up front, you hold on to them, you get to the point where you need to make an exit.
Yeah.
That does not mean it's a bad deal. That does not mean the next guy can't make money on it,
Yes.
right? But you need to understand that versus the guy that bought the deal and flipping out of it 6 months later because it's got such dire problems that they don't even know what to do with it, right?
Yeah.
Two different problems. So really understanding the seller, their motivations, right? I think that's a huge thing that people maybe getting into business don't think about, right? I used to think, me personally, I'm a numbers guy. I used to think it's all about the numbers, and it is, but there's some other soft pieces to it that help you validate.
And I wouldn't say it's not even
about
their motivations too. I would just say it's just about what type of people they are. You know, I mean, I'm not going to name the name of the shop, but we bought a deal here in Texas, and you know, if we had just done some additional research on the seller, we would have realized that these guys were a step above a slumlord, right? And we were buying a property that needed a lot of love. Well, guess what? It needed a lot more love than we were expecting it did. And so if we were a little bit, you know, I think, and this is you make these mistakes when you're starting off, right? You don't do as much due diligence on the seller. Right, you know, but it's like, you know, people here in Houston know Camden, and actually Camden's a nationwide company, but Camden property is going to be probably pretty well maintained, you know, because those guys got a ton of money. They got a lot more money than you guys got, a lot more money than me, and they're going to take care of their properties. Now, they might not. That doesn't necessarily mean that there's not meat on the bone, but that just means that they're not going to have all the deferred maintenance that we had when we took on that property, right? So I agree, knowing the seller, that's going to be, you know, but again, it's not a yes, I should buy it, or no, I shouldn't buy it, just depending on who that is. It's just one data point of many data points that you should be checking the box on, right? So those are some of the characteristics of a profitable multifamily investment. I know that there's a lot more. Love this to be more of an interactive show, so please dump those comments in there. We'll talk about them. Love for people just to kind of, you know, give their advice as to what they think some of the characteristics are. But any questions? Any comments?
No.
Oh my gosh, it's quiet today.
Chime in, but there's one, you know, what strategies can you implement to increase your ROI? I think we've kind of gone through a lot of that, but maybe talk about the big stuff, right? Interior upgrades, carports, operational efficiencies, cutting back expenses, you know, utility, like
so are we talking about like return on investment or NOI?
Well, it's kind of both, right?
So okay, so like, you know, I look at ROI when I'm doing interior unit upgrades, right? You know, and in that case, right, it's going to be more so, you know, I mean, how much money do I have to put into it, and what kind of rent growth can I get?
Yeah,
right?
I'd say the question of how do you improve your ROI, it's kind of maybe hard to answer, because it's really about the way you improve your ROI is by running your numbers before you do something. That's how you improve your ROI. How you improve your NOI is all the things you do to improve value. Right?
Yeah, you're forcing
keeping
appreciation,
occupancy
right?
higher, pushing rents, adding in other revenue streams, right? Even things like, you know, implementing an insurance program that can generate revenue, implementing all these other things that people, amenity fees,
cable and Wi-Fi,
cable, Wi-Fi, all of these things can generate income. So all that will boost your NOI. And again, to the point Ben made, if I have to pay $10 million to get a cable Wi-Fi plan, it probably ROI is not so good.
No.
Right? But if I have to pay $1 and all of a sudden I get all this new money, well, ROI is significant. So it's really about running your numbers and understanding how much you're putting in versus what you're getting.
Yeah, and really you should be running your numbers on interior upgrades especially, right? You know, I mean, how much money do I have to put into this? And right now, depending on the submarket that we're in obviously the Sun Belt, it's 10 to 15K, folks, right now, and that's the going rate now. People can say that's a little light or that's a little high. Doesn't really matter, right? That's what we're seeing, right? So, you know, in order to get at least a 20 to 25% return on investment, you have to have some significant rent growth. I don't know the numbers off the top of my head, but I think it's 150 to 250 is what you need to make. And so we're also targeting deals that have that much rent growth when we put that amount of money in. The other thing that you want to take into consideration too is there's certain things that you're going to have to do as part of CapEx that you're going to have a very low return on investment on, right? As far as rent growth goes, but you might get it on your expense side, right? Because you're going to say, okay, I got to replace the roofs. That stinks, right? I hate spending money on roofs, but sometimes if the roofs are leaking and it's causing you a bunch of problems and you're having to pay a bunch of money, you got to bite the bullet. Somebody at some point has to replace the roofs, right? But your tenants aren't going to care. They're not going to pay you an extra 50 or $100 for rent just because the roofs are brand new. They're just going to say, yeah, I'm glad that they work, right? But at the end of the day, so your return on investment from a rent perspective, not so great. From an expense perspective and an expense savings, not bad, right? So you have to weigh all of those things, but all of that should help you drive your NOI. And your NOI growth is really where you're going to get the most bang for your buck in terms of forcing appreciation on these deals. So, boom, we got it. Thank you for the one question that we got.
Yeah. Any other questions, please ask them. Watch them live. Otherwise, we shall keep going.
Oh my gosh, the early bird. What are we talking about?
Sold a lot of tickets so far, folks. Ooh. Our big conference is here in Houston in our backyard coming up February 11th. So, Multifamily Investor Network. It's a figure of speech. Our backyard means it's in the city that we live in.
It's in Houston.
And so if you guys are interested, check it out, www.mfinvestornetwork.com. It's the best place to go and network and learn something about multifamily, right? Meet somebody new, meet a partner, a friend, an investor, all the above. So definitely check it out. Use discount code EARLYBIRD.
I was gonna have her. I was gonna have her. Okay, so what does it say right there in the middle?
Early bird sale.
Yep. So then what does it say below that? For a limited time.
Get $150 off. Use coupon code EARLYBIRD at checkout.
Boom.
Perfect.
All right.
All right. And I got about 275 emails for you to read from me as well. It'd be great.
All right. So when is it valid till?
Valid until December 16th, 2022.
All right. Your site is way better than Daddy's. All right. So
Yeah, I know.
check that out at www.mfinvestornetwork.com. Put in that coupon code EARLYBIRD. Get your $150 off. A lot of networking, a lot of cool things happening.
Yes, sir.
All right. So
Goodbye.
we're not done yet. Come on, we've got another event to announce.
What are we doing Thursday, Ben?
Oh my gosh, the Houston Real Estate. You want to speak? You want to do it? All right.
Houston Real Estate
Investing
Holiday Networking Mixer.
It's a little bit of a mouthful.
December 1st, 2022, 7 p.m. Central. Wakefield Crowbar.
All right. So this Thursday, folks, 7 p.m., we're having our monthly meetup that we do first Thursday of every month. What would you like to say?
My birthday's on Friday.
It is on Fridays. I will definitely be there for that. Don't worry. This is the night before that. Because it is going to be your birthday on December 2nd, isn't it? How old are you going to be?
9.
You're going to be 9 already?
Yeah.
Oh my gosh, I still remember the second you were born. All right, but I digress. So you got the register, folks, or check it out. Just drop on in, www.disruptequity.com/HTX meetup. Really excited about this. It's going to be our ugly sweater, holiday mixer, networking. You're not going to hear us up there blathering. We're just going to get to know each other. Maybe find your next partner. Maybe find your next deal. Maybe find your next investor. Who knows? But if not, you're still going to have a good time because it's an awesome venue. And we're really, really happy to be out there. So December 1st, this Thursday at 7 p.m. What's coming up next week, my friend?
Talking about our next Money Mondays, how investors / syndicators profit from real estate syndications.
Oh my gosh. Man, we got a lot of profit.
We did get 2 questions, so let's answer these before we wrap up.
Okay.
So same person. First one is prefer private funding or bank money? Bank money.
Oh, what are we talking about?
Private
Equity
funding
versus
is
debt?
kind of weird. Yeah, no, I think I kind of interpret it as debt funds versus a bank, right? Debt funds are usually more expensive,
They're gonna
usually
be more sharky.
more onerous, sometimes more sharky.
Yeah.
Whereas a bank, usually it's pretty clear cut what their box is.
Yeah.
And you know,
if you hit their box, they can usually close.
Yeah.
And their spread
Their
right
spreads
now
are
is going to
better,
be
less
better than a
expensive.
debt fund for sure.
All right, next question. What percentage of the deal purchase price do you usually borrow or pay from your pocket? So usually we'll borrow 60 to 70%
Yeah.
of the purchase price. And then on the equity, again, every operator is different. We're typically putting up 5 to 10% of the equity stack.
That's true. That's true. So I guess, 5 to 10% of the deal, right? Really is what it is, right? Because you're borrowing
5 to 10% of the equity.
Yeah, the equity, right? Yeah. So, I mean, at the end of the day, right, debt is cheaper than equity right now still. But, it's still not bad, folks. So check it out, But we'll be talking next week how investors, syndicators profit from real estate syndications. And one show that I like to do is some goal setting and goal planning for 2023 and what you need to be looking out for in this market too. So be on the lookout for those topics coming up. We'll see you next week, Money Mondays, 3:30ish. Excuse me. Every Monday.
Thank you very much.